Ashish Gupta. He's Chief Investment Officer at Axis AMC. Joins us right now on the show. Ashish, great having you. Thanks for taking the time out. This is Niraj here. Good morning. Hope all is well.
Yeah, good morning, Niraj, and thank you for having me on the show. Hope all is good with you too.
Yep, all well. Thanks, Ashish. Great having you today. And Ashish, I want to start off at the outset. Maybe combine two questions into one. One,
Sure.
do you, by virtue of how you are now tilting the portfolios towards, believe that there could be a heady dosage of consumption aiding policies that could come into play, and therefore is there something that becomes an integral part of your thought process, part one? And if there is a tilt towards some bit of populism, we've seen some first rumors of a farm loan waiver in Telangana, maybe more happen in Maharashtra, etc. It's all a hypothesis. Could overall multiples that India enjoys come into question as well?
So I think if I take the first part of your question, should there be more focus on consumption? Certainly so. And if you look at the India growth story, one of the biggest underpinnings for that always has been really the demographics we enjoy. And really consumption is one of the sectors that benefits the most out of it. So at all points of time, I think consumption is front and center of the economy, of the investment universe. And we have now had really 5 years of downtrend, a cyclical downtrend in consumption for multiple reasons. There was the pandemic-related slowdown, and the recovery from that has been slow. There was high inflation, and that impacted affordability. And all of these are really the cyclical factors that were a headwind are dissipating. And I think irrespective of really change in the policy direction, I think the consumption cycle is due for a rebound. We don't know whether it happens this quarter or 6 months from now or 9 months from now, but it is bound to come back. And I think we have to be positioned for that. Having said that, one thing that also is very pertinent to note is that while consumption stocks have underperformed, they are not really cheap. So if you see the multiples of the stocks, most of those stocks are still at elevated Ps, and the underperformance has not led to cheaper valuations, primarily because you have had earnings disappointment. So I think that is really the big challenge here, that how aggressively you move towards the consumption side when multiples are still about one standard deviation higher than the historic average.
Yeah, that's a pertinent point. Okay, so that's as far as consumption goes, and it's a pertinent point that valuations are not cheap out there. But you position yourself in part because of the recent underperformance. The second is somebody made this point, and I was interested in knowing a buy-side manager's view. Is there, would you be concerned about the overall multiples coming into question if India moves from a largely fisc deficit capex oriented policy to one which also has hints of populism?
So I think the good thing that we have prevailing today is that there is a very strong revenue buoyancy, right? And even if whether you call it populism, whether you say higher spends towards consumption, I think the good news is that the government revenues are strong enough to be able to absorb them. And I don't think India's multiples will get questioned as long as we don't let go of our macro stability, as long as the path towards the fiscal consolidation stays the course. You mentioned that next month all of us are eagerly looking at the budget. And to us, one key monitorable will be the path to 4.5% fiscal deficit is adhered to. And we believe there is enough flexibility with the government. You have seen how buoyant even the advanced tax collections have been. Over the past couple of years, government tax revenue to GDP has increased by 150 basis points. We have had an additional step up in RBI dividend by about 130 basis points vis-a-vis expectations. So I think there is enough room for government to step up spending without diluting the fiscal consolidation. And if that happens, I don't think multiples for the market will get negatively impacted.
Okay. So Ashish, net and what you're saying is, at least even for the near term, the RBI dividend plus the revenues, tax revenues, all of that lead you to believe that both can coexist, that consumer spend as well as fiscal deficit plus the capex as was guided in the budget. Actually, I'm asking you not both, but this troika, can this troika coexist?
Certainly, right? Because if you see in January, forecasted RBI dividend was not over 2% of GDP, right? So I think that alone provides a better revenue maneuverability. We have also seen both in FY24 and in first quarter, the kind of tax collection that have come in have been ahead of estimates, right? And so I think if the fiscal deficit stays in control, if inflation stays modest, we have seen the improvement on the external account already. So the current account is also now almost in a surplus. So I think the macro fundamentals of India continue to be very, very healthy. And it is that which is driving the high multiples. And if there is an additional spend towards consumption, that will actually be positive for market multiples rather than negative for market multiples.
Okay, fair call, which is great to know. The other aspect, Ashish, that people are toying around with is the spend on capex. Now, you mentioned that that might well continue. We've seen India Inc. go slightly slow on payments of dividends as an aggregate in FY24 relative to what we've seen in the past. Is that a precursor of available quantum, or is it a precursor, or is it an indication of available quantum to be paid out as dividend, or is it a precursor to capex plans by the private sector, which hitherto has been in fits and starts and only in select pockets and not quite industry-wide?
Oh, I don't think there's any cause to really be concerned about dividend from India Inc. I think really dividends, the biggest determinant, of course, capex is one of them, but a larger determinant is corporate profitability. If you see corporate profitability has been on an uptrend. A few years ago, corporate profitability bottomed at just about 2% of GDP. If I recollect correctly, last quarter we have hit about 4.2% of GDP in terms of profitability, and payout is quite linked to that. India Inc.'s balance sheet is also very healthy. So the leverage level, as you know, at corporate India is now at a 25-year low. So even as there has been a step up in capex spend, and more importantly, there are more aggressive capex spend, I don't think dividends are going to be really shortchanged. We also are seeing enough opportunity for the corporates to beef up their balance sheet given the buoyant capital market from equity raises. So if you see the number of primary and secondary offerings that are hitting the market, we are virtually seeing 3 to 4 issuances every day. So I think from the cash flow side and profitability side, corporate India probably has really the best scenario that it has encountered in the last 12, 15 years. So I don't think dividends will be a challenge. And I think once we get into FY25, you'll see the dividends will be more than FY24 for sure.
Ashish, I have established with you on your thoughts that one, Capex will not take a back seat, and despite all of that, for whoever is looking at dividend payouts as well, need not be worried too much. You believe that things will go back and improve in FY25 as well. I would love to understand from you whether you believe Capex beneficiaries across that value chain, do they still provide an opportunity? They were fantastic purchases maybe 24 months ago. They've rallied quite significantly. How do you look at some of them now?
I think definitely that's a challenge in the market. As we spoke about earlier, uh, valuations in the market are not cheap. And you can look at it across sectors, across market cap cohorts. Valuations are quite demanding. And I think that's a big challenge. And in fact, while people talk about mid cap, small cap premium to Nifty, we did an analysis, and really rather than splitting companies into market cap cohorts, we split them into cohorts of growth and expected growth. And while average market multiples are only about 21, 22 times, if you look at companies, whether large cap, mid cap, small cap, if the forecasted growth is around 20% plus, the average P is well north of 30 times. So that's the big challenge. And I think the way we are navigating this is really focusing on companies where we are more confident about earnings delivery. Companies where there is potentially larger risk to earnings, that is what we are looking to avoid. And secondly, where there is more longer term visibility of growth. So the growth is multiple years, so that the valuation can grow into the earnings that will go up. We are still quite positive on Capex, industrial manufacturing companies, because we believe the domestic cycle is in favor of them. I talked about corporate profit to GDP improving from 2% to 4% of GDP. And we are hopeful that over the next 3 years, this number is north of 6% of GDP. And that is what underpins our confidence in these companies. But yes, earnings risk is really something that we want to avoid at all costs, given how demanding the multiples are.
Ashish, the other question is there I mean, I don't know how well or how high were you on the PSU investment ladder, if you will, but if you were there, are you redialing the strategy back in tilt of privates or not necessarily so?
So I think the response is similar to the previous question. I think within PSUs as well, we believe the play from here on is not as much of re-rating, but really companies that can deliver earnings and earnings growth. So we are positive on PSU companies in sectors where there is high earnings growth potential, so whether it is power, defense, even financial services. But we are not so positive on PSU companies in sectors which are more commodity linked, for example, where we are not confident of continued earnings growth. So we believe across most parts of the market, the potential for re-rating is now done, and performance will now be much more driven just by how they grow the earnings.
Got it. Ashish, a slightly difficult question. You are a part of the industry in some sense. I am kind of reporting on that industry as well. But I just want to talk about the multiples that if you believe they get impacted in any fashion whatsoever, right? Because there is some capital market brokers over the last two years or something like that have come in part in some fashion under the SEBI scrutiny or SEBI actions. AMCs selectively have also happened there. Does it, it's a very high growth space because India is only starting to invest, right, over the last 5 years. How long is this runway for growth? And do you think that multiples do not get derated necessarily so over a period of 10 years if the growth numbers look so strong? Because like one swallow does not a summer make, it's not that one or two instances necessarily depict the whole sector.
Sure. No, I think that's definitely true, but I think it is equally important for all of us in the market to ensure that trust of investors is maintained. In the mutual fund industry now, there are 45 million investors. As you mentioned, the number of investors is increasing on a daily basis. And we want to ensure that the trust of the investors is enhanced. We at Axis AMC also today have over 10 million individual investors. So we want to ensure that the confidence and the trust they have reposed by giving us a part of their savings is really responsibly addressed. I think we continue to enhance our processes and controls. We continue to move towards more and more transparency. The industry is also very tightly regulated. So I think that should ensure that investors can be confident about the industry as well as individual players in it.
Yeah, most certainly. It's done a whole degree of good for people's wealth creation as well. So one got to recognize that in a big fashion. It's a big boon to have this investment opportunity for investors as they've figured out over the last 5 years. Okay, Ashish, a couple of other things before we call it a day. One, on the two largest buckets in the investment landscape, banks and IT. Now, I presume you are constructive on banks based on what I've read about your previous interviews with other platforms. Is this a big wealth creation opportunity, or will this be a market performer or maybe a slight outperformer over the course of the next 2, 3, 5 years?
I think, again, like most of the sector, the valuations are not really depressed, although financial sector is one of the few sectors where, at least for the few companies, multiples are lower than their historic trading multiples, particularly on the private banks. But we are also seeing a few developments that were not really visible over the past nearly a decade. One is that the public sector banks are now more competitive than they used to be. Their balance sheets have been repaired. The profitability that they are reporting is as good as their private sector peers. So the number of investment opportunities that are available in the financial space across public banks, private banks, non-bank financial companies is larger. And therefore, the growth is going to be much more distributed rather than concentrated in a few players. And therefore, some of these companies might not go back to their historic multiples. The second aspect is that, like capital markets, banking sector is also now much more tightly regulated. The regulator is keen to avoid any over exuberance and wants to ensure orderly growth with not just asset quality but even liability side risk being adhered to. So, for example, they want credit growth to be in line with deposit growth. So it does mean that growth for the the sector will be more moderate compared to the past, and we might not see all the companies reversing back to their historic multiples. If I look at the fundamentals of the banks today, their balance sheets are absolutely clean, probably cleaner than they have been in the last 20 years. Most companies have profitability with ROEs of between 15 to 20%, which make them attractive opportunities. But the trajectory of earnings growth is not accelerated, right? Because credit demand is steady and already the uplift in profitability has happened. So I would expect the sector to outperform the market. But really, for superlative gains, you need multiples to be a kind of much more amenable.
Point well noted. Okay. Ashish, this was lovely talking to you. It's been a while. So thank you so much for firstly taking the time out, and look forward to, and great candid answers. Look forward to talk to you more regularly.
Okay, thank you, Niraj. Thanks for having me on the show.
No, the pleasure was ours. And viewers, this is Axis AMC, a large asset management firm, and Ashish manages the large portfolio. So good to get his views on a multitude of sectors. He doesn't believe that that consumption focus will happen, but it will not happen necessarily at the expense of either fiscal consolidation or a reduction in capex. He believes all three can coexist.